I do also want to kind of revisit the Fed idea, and I'm gonna go to your slide that is related to the Fed and what you call the Fed mistake index. Can you describe this a little bit?
I think it's great. And what it does, so simple terms, it's the effective Fed funds rate. And you could use 3-month Treasury bill, effective funds rate, official policy rate. What it does is it takes the difference of the Fed funds rate and the 2-year Treasury, right?
Hmm.
The 2-year Treasury, you could fire the entire Fed and hire the Treasury market. And the 2-year Treasury does a great job of telling the Fed where the Fed funds rate should be, right? Jeff Gundlach always says the best predictor of the Fed funds rate is the 2-year rate. So what the Fed mistake index does, takes the difference. Today it's plus 100, meaning the effective Fed funds rate is 5.38, and the 2-year was 433. I think no 438. Effective funds rate is 533. The average is minus 50 basis points. So 100 and the 50 gives you, the Fed should cut 150 basis points, and if they do, the Fed funds rate will be exactly in line with the historical 3-month Treasury yield, with the historical Fed funds rate. Banks can't make money when the curve is inverted, right?
Hmm.
The banks just reported very poor earnings. The street expects 9% earnings growth for financials in 2024. That's going to be very hard with an inverted yield curve, right? I'm sure Scott and Justin will agree with this. Hopefully Mike behind the scenes. But my mortgage rate is 2.85, right? I just checked Mortgage News Daily, and it's down from the highs, but it was 6.95 today, right?
Hmm.
6.95 might be less than 8 or 9. It's a lot higher than 2.85, right?
Yeah.
So even though the market has confounded critics, right, and for really good reasons, right, American corporations and consumers are really resilient. Companies were very wise to lock in their debt before the Fed raised their interest rates. Homeowners made sure to lock in their mortgages. All these things have delayed, plus excess COVID cash have delayed the economic reaction a lot of smart people were expecting. But eventually it's going to bite into the economy. So if the Fed wanted to pull off their soft landing, which, as someone's pointed out, in 2007 we had a soft landing before the crash, right? It always feels like a soft landing. And very ominously, if you compare the Fed mistake index now, and it's on your chart, to
Hmm.
right before the big recession of 2008, you can see, and anyone watching online can see, we peaked in '01 and '08 right around 100 basis points. And without looking for parallels to the great financial crisis, there are myriad similarities in the commodities market, in the stock market, in the Fed mistake index. So if I were advising the Fed, I would just say listen to the Treasury market.
Hmm.
It's obviously more distorted than it was historically, but the Treasury market's pretty smart. If I were the Fed, I would cut 150 basis points, and I think that would increase the odds of a soft landing. The longer they feel comfortable, and the slower they go, the higher the odds go that we get another a repo quake, or so we find out some hedge funds are using too much leverage to arbitrage the reverse repo market, the Treasury market. East Asian crisis, for our listeners that have been in the market for a while. Something blows up somewhere, right? So yeah, the Fed is offsides, and they should stick to cutting sooner than later by 150 basis points.
Well, and if they were doing it nice and slow as they tend to, I mean, that's certainly not the way we ramped up. We had a number of 50 basis point hikes, but that would be six quarter point, and I mean that's what a lot of people are expecting. But then on the other hand, I mean, I look at the if the Fed cuts six times, that's usually when there's trouble. That's usually when, like, oh, we're kind of in panic mode. We need to really do something because things are breaking. I mean, and they're usually late, right? That usually happens after some crisis has already started unfolding. So,
You see that in
I
the chart. If you go
yeah.
back a few years, you see how low we got, right? That's when everyone was screaming to the Fed, "Hey, you need to raise rates," right? And they said,
Mhm.
"Well, we
Just
don't
slow
see
things down.
inflation."
Mhm.
What's that, right? And you can see that meant that they had to raise by more than they should have later. So exactly to your point, they were too slow before, and they're kind of too slow now. And I think the Fed thinks they're doing us a service by doing all these interviews and over communicating, right? You remember Greenspan used to show up and people said, how big's his briefcase? Is he in a
Right.
good
Yeah.
mood? Right. There might be something to that. I personally, I would like to have the Fed less operate like a reality TV show. Right.
Mhm.
And you know, they're data dependent. Well, they should be paying more attention to the market. And I agree. The sooner they act, then the less they'll have to overreact later, and hopefully the less of a mess they'll have to clean up. And if I could add, and this is just a hope, this isn't an expectation, I really hope we don't go back to zero. It would be nice if they set a
Right.
floor of somewhere around 2% or so.
A little bit more normal,
Yeah,
because again, 0 was very abnormal. I mean, 2% is still low, but it's not 0,
yeah.
which is where we were for a while.